Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 10th edition of Market Outlook. And again, this week, due to the increased volatility and just the insanity, we're trying to get our commentary out to all people and help navigate this insane environment. So with that, let's get started. First thing to note is that the NASDAQ 100 is on a path of its own, and it looks like it's almost now inevitable, well, I shouldn't say inevitable, but likely that we could end up taking out the highs that were put in February. So very, very unusual environment, big divergence. One of the things you can see, we did go into a situation where the 50-day crossed under the 200, but basically the price movement has continued upwards. So with that, we're in what's called a accumulation phase. Normally, if that 50-day was over the 200, we'd be in a full bull phase. Now, the thing is, what's also apparent is our real motion indicators here are showing we got a bit of compression, and we're not, even with this rally up that's really strong, we're not really overbought. And so there's plenty more fuel potentially to the upside. Now, conversely, the other indices are really at about a 50% or so correction of the move down. So, with this move up. Now, the other thing that's interesting is we've really been in a sideways compression area, right? We had this big move up in IWM, backed off, and we haven't taken that out. So over the last 7 or 8 days of trading, sort of sideways action, hence the more compressed environment. And as you can see, even with this, move up over the last week, we're certainly not in overbought area. So with that, IWM definitely improving versus the bigger cap QQQs that are really strong. We'll get into that in a moment. So it looks like the evidence is still to the positive side. The risk gauges are 100% bullish. We've got that improvement in NASDAQ, improvements overall above the 10-day moving averages, which were being breached on Friday. It looked like we could have had a pretty significant sell-off Monday, but we recovered after all the news about Buffett selling all of his airline holdings. So the market recovered from then and has been on an upward tear. So evidence, at least on a short-term basis, is a bit more positive. And if you take a look at the weekly charts here, things really haven't shifted, right? You can see right now across the board, with the exception of the Qs on a weekly basis, we're still, although we've sort of alleviated the extremely oversold condition, we're still overall under lots of pressure. Although things have improved, right, with the exception of IWM. And when I say they've improved here, let's take a look at the phases of the 4 key indices. So one of the things you can see, the Dow, right, this week actually closed above the 10-week moving average, and it's 200. You got a similar scenario that has been occurring actually for several weeks, where the S&P was much stronger than the Dow, and that's above its 200-week moving average and approaching its 50-week. So that's overall pretty positive. And of course, the QQQs, the NASDAQ, pretty decent on momentum above both of its key 2 moving averages, the 50-week and the 200-week of real motion. and on the pure price chart, we're getting close to the highs. So, upward gravitational pull here. And, once we pass that 60% of this correction, which we did this week, it's telling you that the bias here, certainly in these NASDAQ stocks, with some of the companies really benefiting from staying at home, has pushed this index higher. Okay, now taking a look at volume, one thing that's really clear is the index that has been lagging in terms of price, definitely picking up some lost momentum. And so IWM, strongest out of the group of these four, up 5.8%, even though year to date it's the weakest. So it's making up for some lost ground. The other thing to note, 5 accumulation days, that's telling you that there's an important shift. And you can see here the other indices really sort of neutral on the volume. Diamonds doing a bit better, but still the key thing to take away from this particular table is that NASDAQ is definitely picking up some of that lost ground and could be small caps. And I'm going to get into a particular ETF other than IWM, which is really sort of the momentum plays and the good actual companies with good fundamentals in a particular ETF that is leading even the IWM. So hang on, and I'm going to show you an interesting play in a few minutes. Now, taking a look at the sectors, a couple of other interesting things. Also lending more to at least a short-term positive or bullish case, and that is technology led here or leading up 6.6% for the week, up 3.4% year to date. That's definitely your leading sector. It's also much more speculative. The other thing to note is that consumer discretionary spending up 4.5%, leading the S&P, which is only up 3.4% for the last 5 days for the week. Utilities, conservative play, risk off, was one of the was the weakest sector. So it's telling you that money's definitely flowing into more speculative sectors. And of course, retail hit hard for the year, but for the week, getting some love here. So that's a positive sign too, that retail is definitely picking up. And the other thing to note, home builders, which has also been beat up pretty good, had a very, very good week. These are all positive signs, and in fact that the easing obviously of isolation, quarantine is definitely giving a helping hand to the market. Now, take a look at market hotspots here. Let's just take a look. One of the things you can also see is some of the stuff that's really been leading, like bonds, certain asset classes. The safety of bonds has definitely been on pause, So for the last week, it was down 2.36%. That's interesting because a lot of the benefit here of easy credit and fiscal and both fiscally and monetarily has definitely had a positive effect for bonds over the last 6 months. But that's sort of giving up a little bit, and it's very possible that you could have a pause here and a sell-off in some of the risk-off assets. So the other thing to note is that volatility got crushed this week, and this is important because taking out this insane volatility is going to make investing or even shorter term trading a lot more interesting. Now, with that, inflationary pressures are still obvious. So metal and metal mining, one of the bigger 5-day movers, that's important. You even got a bounce in energy, and that's a positive too as the economy opens up. Even in terms of energy, solar power got a pretty good boost, and you can see over the last 6 months, it's actually up and positive. So, overall here, the rotation into different asset classes and the sectors looking a lot more as to benefit risk on. Okay, the next thing is looking at bonds here. So the thing about the bonds is we definitely have a momentum divergence, and we're sitting with an inside day pattern right at the 50-day moving average. And when I'm talking about a divergence, right, you can see here, right, we basically at around the 170 level, right, in terms of price and momentum hit this level up here when we made new highs in price just above 170. We couldn't match it on momentum, and now we've got a breakdown and we broke this swing low, and we're also on the price chart, if we take out this 50-day moving average and this inside day pattern, that could tell us that we could get a test potentially back to the 200-day moving average. And of course, if you look at the long bond versus a blend of various decent or good credit BND, which is really a blend of different durations, long bonds definitely losing some steam, and it's certainly not performing as well as the underlying stock market. So, there's a limit of how far that can go, because I don't think the market is prepared for higher rates in a meaningful way longer term. I mean, that could really hurt the market. So I see this more as sort of a technical shorter term scenario, which is not sustainable. And certainly if the market starts to sell off because bonds get hit, I think the Fed would come in and fix that and plug that and support the equities market. Okay, moving on to themes by market cap. We've been talking a lot about the IWM and the big divergence from the Qs, right? High tech, big cap stocks, and also versus the S&P. So one of the things you can see is we're definitely getting some strength, at least on a short-term basis. So over the last couple of weeks, we've definitely been improving versus the S&P. So this is the IWM, right? We closed above the 10-day moving average. We're above the 50. Listen, we're still in what I would call an overall weak recovery phase, but we are improving against the S&P and larger cap. So that's an important theme that we don't want to ignore. And it's, can be seen as a positive that these smaller cap stocks are going to get some love, meaning that the recovery is sustainable and potentially really in place. But I really want to see it take out this moving average here, which is quite a bit higher, and that would mean that the longer term relationship between small caps and bigger caps is really on a stronger uptrend than just short term here, which is definitely improving, but yet not what I would call a significant major trend reversal. That can occur though, and of course the seeds now are in place, so we're going to watch this here. Now, let's take a look at value versus growth. one thing that's clear is that growth stocks are still killing the market overall, right? NASDAQ, as it's been moving up, way outperforming value. Nobody really seems to care. And as you can see, value versus the S&P continuing to plunge to new low. Value versus growth. You can see here value stocks basically hitting new lows. Now we are at the bottom of a channel, so it might have gotten a bit overextended on a shorter term basis, that relationship, but we'll have to see how that plays out. But nonetheless, look at the difference here. Growth stocks, right, well above its 200-day moving average, right? You can see here growth versus the S&P beating that as well. So growth stocks still leading. That's a overall positive sign for the overall market. Okay, now looking at sectors, two big themes still in play is that semiconductors, right, the technology sector, you can see here leading, showing price leadership, good volume. Biotech, in a bull phase here, and obviously great volume, still good leadership, good momentum, and still plenty more room on the upside. Even though we're running strong, we are certainly not overbought looking at our real motion indicators. So that is still showing, these two sectors still showing leadership. Okay, the other key thing I want to note here is agricultural commodities, and commodities just in general. With the amount of money that's been pumped in fiscally, monetarily, etc., it's not surprising that we would start seeing some potentially inflationary pressures. So one thing here, we've been in this long-term downtrend, and we've got the bottom end of the channel where we started to bottom out here over the last 5 or 6 weeks. So you can see we've made no further progress on the downside. And in fact, as we hit a new low just a week or two ago, we sort of weren't able to do it on a weekly momentum basis, and we were pretty wrung out and oversold, and now have moved back inside the Bollinger Bands. And we're also potentially about to take out this 10-week moving average, which would occur above the 14 level. So it could be that we're going to start seeing some inflationary pressures kick in. Now, on a relative basis on the weekly chart here, we're still running pretty weak. So I would really like to see some good relative performance as well. Now, if we back up to the daily chart here, you can see it's struggling a bit to get above there, but it might, right? DBA versus SPY, looking at this ratio, we're sort of on the cusp of breaking out. Now, the other thing is on the daily charts, the momentum is starting to look like it's definitely improving over the underlying price action. So one thing you can see, this is the 50-day moving average. We're beneath it. However, using our real motion indicator, we're above it, right? So there's a divergence on the daily charts setting up. What we really want to see is a bit more convergence of price action and the better real motion or momentum that's showing up. So keep an eye on commodities and overall the bigger inflationary picture. And then finally, let's take a look at gold and oil. So the thing here, gold looks like, it's been a leader, but it's on pause at the moment, stuck inside this trading range, right? So you've got this trading range here, whichever way it really breaks out from here is going to probably be an important indication over the next several months, sort of an intermediate term indication. Now, the other thing that's interesting to note is that USO oil has actually had a bit of a rally, move back over the 10-day moving average, which is, a positive sign. I'd like to see a little bit more strength versus the S&P, and I'd feel a little bit more comfortable about getting back in. There is an important gap around the mid-20s in USO. If we could take that out, start filling the gap and move back up to that 30 level, that would be a pretty positive sign. And of course, the benefit here of a economy opening up is actually we'll be using our cars and using energy, which would take the glut off the market and ease up the pressure on the energy market. So definite improvement here. So finally, before I go, I'm going to bring up another chart. So let's take a look at, so this is IWM, right? Clearly the weakest out of the bunch, right? We're up at 170. We got down to 100. You're talking about well over a 40% drop in this particular index, right? Small caps, US based. We had a nice bounce, can't argue with it, but we're still around a 50% correction off the lows, right? So it's hard to say exactly which way this is going to break, right? So here to here, and then here back up, 50% correction, and we're still in this sideways action here. And this is very indicative of the overall U.S. economy, right? All domestic-based companies. Now, with that, a subset of this is small cap growth stocks. So IWM is an index of 2,000 stocks. There's, hold on here. Okay, so what I want to focus on here, this is the Vanguard small cap growth. So as opposed to just all small caps grouped together, the metrics here mean that this group of stocks or this ETF has to demonstrate some level of growth. And as you can see, this thing is doing a lot better than the overall IWM, which is a much bigger index. So, right, we're almost at this 200-day moving average. We clearly have made a new high. We've got, an interesting trend line now off, this low, and this low. That's 3 points. And so you've got a valid trend line. We certainly don't want it to break down here, or really even under what I would call the low of the day before of Thursday. So we want to see this momentum continue. But what's interesting is this small cap growth fund doing a lot better than the overall IWM. So that's interesting to note, and that could be a way to take advantage of the outperformance potentially setting up in small caps, as this is a subset with much better price performance, especially during a recovery. All right, hope this all helps, and hope you're all staying safe. I'm sure we're all looking forward to the isolation and lockdown being eased. Stay safe again, and see you next week. Bye for now, and good luck with your trading.